Something extraordinary is happening in the silver market right now, and if you're not paying attention, you're about to miss one of the most explosive moves we've seen in decades. I'm talking about a coiling pattern that's so tight, so compressed, that when it breaks, the velocity is going to shock even seasoned traders. Let me show you exactly what I'm seeing and why the next few weeks could change everything for anyone holding physical silver. Look at the chart. Silver has been consolidating in an increasingly narrow range, and every time it tests resistance, it's holding higher lows. This isn't random price action. This is accumulation. This is smart money quietly positioning themselves before the crowd realizes what's happening. The technical setup we're seeing right now mirrors some of the most violent breakouts in silver's history, and I'm going to walk you through exactly why this time could be even bigger. But first, let me ask you something. Do you remember what happened the last time silver coiled like this? I'm talking about the kind of compression where volatility contracts so much that the spring is wound tighter and tighter until it can't hold anymore. When that spring releases, silver doesn't move in percentages. It moves in multiples. And right now, every indicator I'm watching is screaming that we're approaching that release point. The technical picture is just the beginning. What's happening beneath the surface is even more compelling. Global silver demand has hit levels we haven't seen in modern history, and here's the kicker. Supply isn't keeping up, not even close. Industrial demand alone is consuming silver faster than mines can produce it, and that's before we even talk about investment demand, which is surging as people wake up to what's coming in the broader economy. Think about this for a second. Silver is used in solar panels, electric vehicles, 5G infrastructure, medical devices, and countless other technologies that are expanding exponentially. Every single solar panel requires silver. Every electric vehicle uses significantly more silver than a traditional car. The green energy transition that governments around the world are pushing, it's a silver consumption machine. And unlike gold, which sits in vaults, silver gets consumed. It's used up. Once it's in a solar panel on a rooftop, it's not coming back to the market. Now layer on top of that the investment demand. Central banks have been accumulating gold at record pace, and that's pushing investors to look at silver as the more affordable precious metal with even more upside potential. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of history, that ratio sat around 15-1. Right now, even after silver's recent strength, we're still seeing a ratio that suggests silver is dramatically undervalued relative to gold. Before we go further, I want to mention something quickly. If you're watching this and you're thinking about how to protect your wealth in this environment, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Grab it while it's still available, because what I'm about to show you is going to make it very clear why protection matters right now. Let's talk about what's happening at the COMEX, because this is where things get really interesting. The COMEX is where silver futures are traded, and it's also where the paper silver market operates. For years, there's been a massive disconnect between the paper market and the physical market. Traders can buy and sell contracts representing silver without ever touching an actual ounce of metal. But here's the problem. The amount of paper silver being traded dwarfs the amount of physical silver that actually exists to back those contracts. What happens when everyone holding paper silver decides they want physical delivery? That's the question that keeps the big banks up at night. We've already seen stress in the physical market. Premiums on physical silver coins and bars have been elevated for months. Dealers are struggling to keep inventory. Mints around the world are reporting delays. This is what happens when demand for physical metal outstrips supply, and we're still in the early innings of this trend. The smart money knows this. That's why we're seeing institutional accumulation. Large funds are quietly building positions in silver, not because they're speculating on a quick trade, but because they understand the structural deficit that's developing. When institutions move into a market, they don't buy a little bit, they buy size. And when they buy size in a market as relatively small as silver, it moves the price. Here's something most people don't realize. The entire silver market is tiny compared to other asset classes. The total value of all the silver ever mined that still exists above ground is a fraction of the market cap of a single large tech company. When big money decides to allocate even a small percentage of their portfolio to silver, it has an outsized impact on price. We're starting to see that flow happen right now. Let me paint you a picture of what happened in past silver breakouts, because history doesn't repeat, but it sure does rhyme. Go back to the late 70s. Silver was trading in the single digits for years. Then the Hunt brothers started accumulating, and suddenly silver went from under $10 an ounce to $50 an ounce in a matter of months. That's a 500% move. Now, I'm not saying we're going to see the exact same scenario, but the dynamics of a tight market with surging demand and limited supply create the conditions for explosive moves. Fast forward to 2011. Silver had been in a bull market, but it was still under $20 an ounce at the start of the year. By April, it had nearly hit $50 again. That's more than a 150% move in just a few months. What drove it? A combination of monetary policy concerns, inflation fears, and a rush into hard assets. Sound familiar? Because we're seeing all of those factors line up again right now. The difference this time is that the structural demand for silver is even stronger. Back in 2011, we didn't have the same level of industrial demand we have today. The solar industry was a fraction of its current size. Electric vehicles were barely on the road. 5G didn't exist. The industrial consumption of silver has fundamentally changed, and that creates a floor under the price that didn't exist in previous cycles. Now let's talk about what's happening in the macro environment, because silver doesn't trade in a vacuum. The Federal Reserve has been navigating a tightrope between controlling inflation and not crashing the economy. Every time they hint at pausing rate hikes or cutting rates, precious metals rally. Why? Because lower interest rates make holding non-yielding assets, like silver, more attractive, and they also signal that the currency is being debased. When the dollar weakens, hard assets strengthen. But it's not just about the Fed. Look at what's happening globally. Countries around the world are moving away from dollar dependence. The BRICS nations are actively working on alternative payment systems. Central banks are diversifying their reserves away from dollars and into gold and other hard assets. This is a slow-moving tectonic shift, but when it accelerates, the implications for precious metals are enormous. Here's where it gets even more interesting. The geopolitical landscape is more unstable than it's been in decades. Trade tensions, military conflicts, political uncertainty, all of these factors drive investors towards safe haven assets. And while gold gets most of the attention as the ultimate safe haven, silver benefits from the same flight to safety, often with even more volatility and upside. Think about what happens when a major geopolitical event hits the headlines. Investors panic. They sell stocks. They sell bonds. They move into assets that can't be printed, that can't be devalued by a government decree. Silver is one of those assets. And because the silver market is smaller and less liquid than gold, the moves can be more dramatic. Let me give you a real-world example of how fast things can change. Remember the banking crisis that unfolded recently? Regional banks were failing, depositors were panicking, and suddenly everyone was questioning the stability of the financial system. What happened to silver during that period? It spiked, hard, because when confidence in the system cracks, people run to tangible assets. They want something they can hold, something that doesn't depend on a bank's balance sheet or a government's promise. Now imagine what happens if we see another wave of financial instability. Imagine if inflation comes roaring back and the Fed is forced to choose between crushing the economy with higher rates or letting inflation run hot. Either scenario is bullish for silver. Higher rates eventually break something in the financial system, which drives safe haven demand. Lower rates and persistent inflation make hard assets the only place to preserve purchasing power. The setup we're seeing right now is what traders call a coiled spring. All the pressure is building. The technical pattern is tightening. The fundamentals are screaming. The macro backdrop is supportive. And the physical market is showing signs of stress. When all of these factors align, the breakout isn't a question of if, but when. And here's the thing about breakouts. They happen fast. By the time the mainstream media is talking about silver's rally, the easy money has already been made. The people who position themselves before the move are the ones who capture the real gains. The people who wait for confirmation end up chasing the price higher and buying at levels that feel uncomfortable. So what are the levels to watch? Technically, silver has been consolidating below a major resistance zone. Every time it tests that level, it's holding higher lows, which tells you that buyers are getting more aggressive. When that resistance finally breaks, the next leg higher could be swift and substantial. Traders are watching for a decisive close above that level, because once it breaks, it often triggers a cascade of buying as stop losses get hit and momentum traders pile in. But let's zoom out for a second and talk about the bigger picture, because this isn't just about making a quick trade. This is about understanding where we are in the economic cycle and positioning yourself accordingly. We're living through a period of unprecedented monetary experimentation. Governments have printed more money in the last few years than in entire decades prior. Debt levels are at all-time highs. The financial system is more fragile than most people realize. In that environment, hard assets aren't just an investment, they're insurance. They're a hedge against the possibility that the system doesn't hold together the way we hope it does. And silver, with its dual role as both an industrial metal and a monetary metal, offers a unique combination of upside potential and downside protection. Let me tell you about something that doesn't get talked about enough: the paper to physical ratio in the silver market. For every ounce of physical silver that exists, there are multiples of that amount traded in paper contracts. This works fine as long as everyone is content to trade paper. But what happens when a significant portion of those paper holders demand physical delivery? The system doesn't have the metal to deliver. That's when you see a short squeeze, and that's when prices can go parabolic. We've seen glimpses of this dynamic already. There have been moments when the physical market tightened and premiums spiked, but we haven't seen a full-blown squeeze where the paper market breaks down and price discovery shifts entirely to the physical market. If that happens, the move in silver could be unlike anything we've seen in modern times. Now, I want to take a quick moment here because this is important. If you're sitting on retirement accounts worth $100,000 or more, you need to understand how precious metals can fit into your wealth protection strategy. I put together a comprehensive guide on how gold IRAs work, how you can get physical gold and silver into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. This is about protecting what you've spent a lifetime building, especially with everything we're seeing in the economy right now. Market instability, geopolitical tensions, currency debasement. These aren't theoretical risks anymore. They're real, and they're accelerating. Check out that guide if this is relevant to your situation. All right, back to what's happening in the silver market. Let's talk about the supply side, because this is where the story gets even more compelling. Silver mining is not easy, and it's not getting easier. Most silver is actually produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of those other metals. If copper prices fall and copper mines shut down, silver production falls too, even if silver prices are rising. And here's the kicker: we're not seeing a wave of new silver mines coming online. Exploration has been underfunded for years. The easy deposits have already been mined. The remaining deposits are deeper, lower grade, and more expensive to extract. This means that even if silver prices rise significantly, supply can't respond quickly. There's a lag time measured in years, not months, between deciding to develop a new mine and actually producing silver from it. Meanwhile, demand is accelerating. The solar industry alone is projected to consume record amounts of silver in the coming years. Electric vehicle production is ramping up globally. 5G infrastructure is being built out. Medical applications are expanding. And on top of all that industrial demand, you have investment demand from people who are waking up to the risks in the financial system and looking for ways to protect their wealth. This is what's called a structural deficit. It's not a temporary imbalance that gets corrected quickly. It's a fundamental mismatch between supply and demand that takes years to resolve. And in commodity markets, structural deficits lead to price spikes. We've seen it in other markets. We saw it in uranium. We saw it in lithium. We're seeing the early stages of it in silver right now. Let me give you another angle on this. Think about what happens when a commodity goes into deficit. Inventories start to draw down. At first, it's gradual. The market doesn't panic because there's still metal available. But as inventories continue to fall, the market starts to get nervous. Buyers become more aggressive. They're willing to pay higher prices to secure supply. And if inventories fall to critically low levels, that's when you see panic buying and price spikes that shock everyone. We're watching inventories in the silver market closely, and the trend is clear. Stockpiles at exchanges have been declining. Warehouse inventories are being drawn down. This is happening while demand is rising. That's the recipe for a squeeze, and it's playing out in real time. Now let's talk about the elephant in the room: inflation. Everyone's been focused on whether inflation is transitory or persistent, whether the Fed can get it under control, whether we're heading into a recession or a soft landing. But here's what matters for silver. Inflation erodes the purchasing power of currency, and that makes hard assets more valuable. It's that simple. When people see their savings losing value, when they see prices at the grocery store climbing, when they see their utility bills rising, they start looking for ways to preserve their wealth. Some buy real estate, some buy stocks, and some buy precious metals. Silver, being more affordable than gold, becomes an attractive option for people who want exposure to precious metals, but don't have the capital to buy significant amounts of gold. But it's not just retail investors. Institutions are paying attention too. Hedge funds, family offices, pension funds, they're all looking at the macro environment and trying to figure out how to protect their portfolios. And increasingly, they're allocating to commodities and hard assets. When institutional money flows into silver, it moves the market in a big way. Here's something else to consider: the correlation between silver and other assets. Historically, silver has had a low correlation to stocks and bonds, which makes it an excellent diversification tool. When stocks are falling, silver often holds its value or even rises. When bonds are getting crushed by inflation, silver benefits. This makes it a valuable component of a balanced portfolio, especially in uncertain times. And we are living in uncertain times. The geopolitical landscape is shifting. The monetary system is under stress. The financial markets are more interconnected and fragile than ever. In this environment, having exposure to assets that aren't dependent on the health of the financial system isn't just smart, it's essential. Let me tell you about a conversation I had with a mining executive recently. He told me that the silver market is the most misunderstood market in the world. Everyone focuses on gold, but silver has all the same monetary properties as gold, plus it has industrial demand that gold doesn't have. He said that when the silver market finally wakes up to the supply-demand imbalance, the move is going to be violent. Those were his words, violent. And he's not alone in that view. Talk to anyone who's been in the precious metals market for decades, and they'll tell you that silver is the most explosive metal when it moves. It has more volatility than gold. It has more leverage to the macro trends, and it has the potential for bigger percentage gains because it's starting from a lower base. Think about the psychology of the market right now. Most investors aren't paying attention to silver. It's not making headlines. It's not the hot trade that everyone's talking about. But that's exactly when the best opportunities present themselves. By the time everyone is talking about it, by the time it's on the cover of financial magazines, the easy money has been made. The smart money is positioning now. They're accumulating while the market is quiet. They're building positions while prices are still reasonable. They're not waiting for confirmation. They're not waiting for the breakout to happen. They're positioning ahead of it because they understand that once the move starts, it's going to be too late to get in at attractive levels. So what does all this mean for you? It means that if you've been thinking about adding silver to your portfolio, now is the time to pay attention. The technical setup is there. The fundamentals are there. The macro backdrop is there. All the pieces are in place for a significant move higher. But here's the thing. You have to act before the crowd does. You have to position yourself before the breakout happens, because once silver starts moving, once it breaks through that resistance and momentum kicks in, the price is going to gap higher. You're going to wake up one morning and see silver up 5, 10, 15%, and you're going to wish you had positioned yourself earlier. This isn't about trying to time the exact bottom. This isn't about waiting for the perfect entry. This is about recognizing that we're in a coiling pattern, that all the pressure is building, and that when it releases, the move is going to be fast and substantial. The people who capture that move are the ones who position themselves now, not the ones who wait for confirmation. Let me leave you with this thought. In every major bull market in silver's history, there was a moment before the big move where everything was in place, but the market hadn't moved yet. That's the moment when the smart money was accumulating. That's the moment when the opportunity was greatest. And that's the moment we're in right now. The coiling pattern we're seeing isn't going to last forever. The compression can only build for so long before it has to release. And when it does, silver is going to launch vertically. The question isn't whether it's going to happen. The question is whether you're going to be positioned for it when it does. So take a hard look at your portfolio. Think about your exposure to hard assets. Think about what happens if inflation stays elevated, if the financial system shows more cracks, if geopolitical tensions escalate. Think about where you want to be positioned when silver makes its move. And if you've made it this far in the video, I want to offer you something exclusive. That free guide I mentioned earlier, if you're an American retiree with at least $100,000 in any retirement account, and you grab that guide from the description, you'll also get access to a one-on-one educational web conference at no cost and with no obligation. Just mention that you watched this video all the way through. This is only available to people who are serious about protecting their wealth, and it's only available for a limited time. The silver market is coiling for a vertical launch. The setup is there. The fundamentals are there. The opportunity is there. Don't miss it.